Airbus spent $25 billion building the biggest passenger jet ever made. Emirates flew it and printed money. Lufthansa flew it and barely broke even. Airports spent hundreds of millions rebuilding runways for it. Engine makers signed decade-long maintenance contracts on it. Leasing companies collected checks on it for years. Everyone found a way to profit from the A380 except the one company that actually built it. Airbus never recovered its development costs, and by the time production ended, the math simply never closed. This is the story of how a single airplane became one of aviation's strangest wealth transfers, where the manufacturer absorbed the risk and everyone downstream collected the reward. And it starts with a number that should have ended the program before it ever left the drawing board. In December of the year 2000, Airbus committed €9.5 billion to building the A380, a figure that would eventually balloon past $25 billion by the time the program wound down. The plan was straightforward on paper: build something so large, so far beyond anything Boeing had, that airlines would have no real alternative for high-density routes. Airbus needed to sell around 420 aircraft just to break even on development costs, a number that assumed steady demand for decades. They sold 251. That gap wasn't a rounding error. It was the entire program's verdict written in one comparison. Airbus kept manufacturing A380s until 2021, and even accounting for the aircraft it did sell, the company never recouped what it spent designing, engineering, and certifying the plane. Aviation Week later described it plainly, a prime example of a manufacturer misreading its own market by a wide margin. But here's what makes the story more interesting than a simple failure. The airlines that bought the A380 weren't losing sleep over Airbus's balance sheet. Airbus had bet its own capital on a forecast that never materialized, and airlines negotiated hard enough that they rarely paid anywhere close to what the plane actually cost to build. List price for an A380 ran into the hundreds of millions, but real-world discounts of 30 to 50% were standard, pushing effective sale prices down to somewhere between $220 and $310 million per aircraft. Airbus was essentially subsidizing its own flagship product just to keep the order book from collapsing entirely. Every plane that rolled out of the Toulouse assembly line represented years of sunk engineering cost, spread across a customer base that had all the negotiating leverage in the room. The airlines knew Airbus needed the sales more than the sales needed Airbus. That imbalance would define the entire relationship for the next 2 decades. Once an airline actually owned an A380 at a discounted price, the economics on their side of the ledger looked completely different. A 4-engine aircraft is expensive to operate, no question. But if you already own the plane below its true cost and you can fill it, the per-flight math can turn genuinely profitable. Take a well-loaded Dubai to London route. A single A380 flight can generate around $400,000 in ticket and cargo revenue against roughly $155,000 in combined fuel, crew, and airport costs, netting close to $245,000 in profit on that one flight. Scale that across a week of flying, and an airline running the aircraft efficiently could clear close to $1 million in profit per aircraft per week under the right conditions. That's an extraordinary number. It's also a number that only makes sense for one specific kind of operator, and Airbus discovered that the hard way. The airlines that struggled with the A380 weren't struggling because the plane was badly designed. They were struggling because their route networks couldn't consistently deliver the load factors the aircraft demanded. Analysts generally put that threshold above 80% occupancy on nearly every flight just to stay profitable, a bar that left almost no room for a slow travel season, a competitor undercutting fares, or a route that simply wasn't popular enough. Airlines that only owned a handful of A380s felt this most acutely. Running a sub-fleet of 10 of the largest aircraft ever built means maintaining specialized parts inventories, training crews on a separate type rating, and building ground infrastructure, all for a tiny slice of your total fleet. The fixed costs don't shrink just because you own fewer planes. Emirates President Tim Clark was blunt about this when discussing Air France's 10-aircraft fleet, calling it a fundamentally different, harder economic proposition than running 100. And that distinction between an airline with 10 A380s and an airline with 100 turned out to be the single most important variable in the entire story. Emirates didn't just buy A380s. Emirates restructured its entire global strategy around them. Dubai sits almost exactly between Europe, Africa, and Asia, a geographic accident that Emirates turned into the foundation of a hub-and-spoke empire. Instead of flying dozens of thin routes connecting mid-sized cities directly, Emirates funneled travelers from everywhere on Earth through one airport and back out again. A passenger flying from Manchester to Auckland or Johannesburg to Bangkok could realistically connect through Dubai on an Emirates A380 without ever considering it a detour. That's not a coincidence. That's the entire business model, engineered around one airplane's strengths. At its peak, Emirates operated 8 A380 flights a day to London Heathrow alone. At a slot-constrained airport, where every takeoff and landing slot is scarce and valuable, putting 500 passengers on one aircraft instead of 250 on two is not a nice-to-have. It's a structural advantage competitors simply couldn't replicate without owning the same aircraft. But the real secret to Emirates' profitability wasn't filling all 500 seats equally. It was understanding which seats mattered. Roughly 15% of the seats on an Emirates A380, the first and business class cabins upstairs, generate close to half of the flight's total revenue. Economy fills the plane and covers marginal costs. First and business class is where the actual profit lives. Emirates built its entire premium product, the private suites, the onboard shower spa, the bar at the back of the upper deck, specifically to maximize that narrow but lucrative slice of the cabin. Tim Clark didn't order 10 A380s to test the waters. He ordered 123, nearly half of every A380 Airbus ever built. At that scale, maintenance costs per aircraft dropped, crew training became standardized across an enormous fleet, and the spare parts supply chain finally made economic sense. Everything that made the A380 punishing for a 10-aircraft operator became manageable, even advantageous once you owned 100. Here's the uncomfortable truth underneath Emirates' success. The A380 program didn't have a broad customer base. It had one dominant customer, and everyone else was a rounding error by comparison. When a single airline accounts for nearly half of all units sold, the entire production line becomes hostage to that airline's decisions. Every order Emirates placed kept assembly lines running in Toulouse. Every order Emirates didn't place put those same lines at risk. Airbus wasn't selling to a market. Airbus was selling to Tim Clark and hoping the rest of the industry would eventually follow. They didn't, not at scale. Lufthansa flew its A380s on premium routes like Frankfurt to New York, and the numbers told an honest story. Cost per seat dropped exactly the way Airbus promised. But so did revenue per seat, because dumping 500 seats onto a single route forces fare discounting to fill them. Lufthansa ended up roughly breaking even, carrying twice the operational complexity of a smaller aircraft for a similar bottom line. That's not a disaster, but it's not the transformative economics Airbus had sold to the boardroom. Airlines beyond Emirates and a handful of others quietly reached the same conclusion. The A380 worked brilliantly for a hub-funneling giant with geographic advantages and premium heavy demand, and it worked poorly for almost everyone else. Air France ran 10, Singapore Airlines ran 19, Qantas ran 12. None of them came close to Emirates' scale, and none of them came close to Emirates' profitability on the type. This is the part of the story that gets lost in most retrospectives. The A380 wasn't uniformly a bad investment. It was a spectacular investment for exactly one airline's specific geography and business model, and a marginal to losing investment for nearly everyone else who bought it, hoping to replicate that success without replicating the conditions that made it possible. While airlines were figuring out whether the A380 worked for their networks, an entirely different set of companies were quietly cashing in without ever flying a single passenger. Start with the engine makers. Rolls-Royce and Engine Alliance, the GE and Pratt and Whitney consortium didn't just sell engines to Airbus once. They signed long-term maintenance and support contracts that generated revenue for decades after the initial sale. Every A380 in service needed scheduled overhauls, parts replacements, and engine swaps throughout its operational life. And that recurring maintenance revenue flowed to the engine manufacturers, regardless of whether Airbus's own program ever turned a profit. The four-engine layout that made the A380 expensive to fly also made it lucrative to service, because four engines mean roughly double the maintenance contracts of a twin-engine aircraft. Then there were the airports. This sounds backward at first, since airports had to spend enormous sums preparing for the A380, reinforcing runways, building double-decker jet bridges, widening taxiways. But once that infrastructure existed, airports captured landing fees, gate fees, and passenger facility charges on an aircraft carrying twice the passengers of a standard widebody. More passengers moving through duty-free shops, restaurants, and lounges on a single aircraft movement meant more non-aeronautical revenue per slot. Precisely the kind of efficiency airports like Heathrow and Dubai International were chasing. Leasing companies found their own angle too. Even as some A380s struggled to find buyers outright, leasing firms structured deals that guaranteed steady payments regardless of how the underlying route economics performed for the airline. Airbus bore the manufacturing risk. Airlines bore the route risk. Everyone positioned downstream of the initial sale, engine makers, maintenance and repair providers, airport authorities, leasing structures, captured revenue streams that were largely insulated from whether the A380 program as a whole ever turned a profit for the company that built it. And then there was the problem nobody in the supply chain wanted to talk about out loud. What happens when an A380 gets old? Normally, aging aircraft have a second act. When an airline retires a 737 or a 777, another carrier buys it secondhand and keeps flying it, often for another decade or more. That secondhand market is a crucial part of an aircraft program's long-term economics because it lets the original buyer recover some capital and gives the manufacturer a healthier resale ecosystem that supports new orders. The A380 never developed that market. When Singapore Airlines retired its first A380s after just 10 years, practically brand new by commercial aviation standards, there was no line of buyers waiting. The aircraft were scrapped. Only around 20 airports worldwide can even physically accommodate an A380's wingspan, weight, and gate requirements, which meant the pool of potential secondhand buyers was tiny from the start. An airline looking to add capacity cheaply couldn't simply pick up a used A380 because operating one meant committing to the same runway reinforcements, double jet bridges, and specialized ground equipment that made the aircraft such a heavy lift for new buyers in the first place. This mattered enormously for Airbus's long-term positioning, even if it barely registered for the companies making money off aircraft already in service. A healthy secondhand market signals confidence in a platform's future and encourages airlines to place new orders, knowing they can eventually offload the aircraft. Without it, every A380 order was a bet with no exit ramp. Airlines that already owned their fleets kept extracting value from them, Emirates most of all, planning to keep its A380s flying into the mid-2030s. But for Airbus, the absence of a resale market was one more signal that the program had no path to a second wind. By 2019, the writing was on the wall. Emirates, the airline that had single-handedly kept the program alive for the better part of 2 decades, began trimming its own order book, and no other carrier stepped up to fill the gap. Airbus announced it would end A380 production by 2021, closing the book on a program that never delivered the returns its own internal forecasts had projected 2 decades earlier. The final delivery went to Emirates in December of 2021, fittingly closing the loop on the relationship that had defined the entire program. Of the 251 aircraft ever built, roughly half belonged to a single carrier. Airbus had spent $25 billion developing an aircraft that ultimately depended on the continued enthusiasm of essentially one customer. The 4-engine layout that once seemed like a mark of prestige had become an unambiguous liability by the time production ended. Twin-engine aircraft like the 787 and A350 achieved comparable or better unit economics at a fraction of the size, without needing the airport infrastructure investment or the massive load factors the A380 demanded just to break even. The industry had shifted decisively toward point-to-point flying, connecting mid-sized cities directly rather than funneling everyone through a handful of super hubs, and that shift undercut the entire premise Airbus had bet its flagship on. COVID-19 delivered the final, almost symbolic blow. Airlines around the world grounded their A380 fleets early rather than fly them at reduced capacity during the pandemic, and several carriers used the disruption as cover to retire the type altogether, rather than bring it back once travel recovered. Production had already ended by then, but the pandemic made unmistakably clear that the giant four-engine jet had no realistic path back to relevance in a post-pandemic aviation market obsessed with efficiency. So here's where the story actually lands. The A380 wasn't a failure in the way most industrial disasters are failures. It didn't crash, it didn't get grounded for safety issues. Passengers loved it genuinely and consistently for its space, its quiet cabin, its double-deck design that felt more like a small hotel than an aircraft. Pilots enjoyed flying it. Airlines that figured out the right formula made real money on it for years. The failure was narrower and more specific than that. Airbus built an aircraft whose economics only worked at a scale and geography that essentially one airline possessed, and then spent $25 billion discovering that everyone downstream, from Emirates to Rolls-Royce to the Port Authority of New York, could profit from that airline's success, while Airbus itself never recovered the cost of making it all possible. Emirates will keep flying its A380s into the mid-2030s, still profitable, still filling those upper deck suites that generate half its revenue from 15% of its seats. Engine manufacturers will keep collecting maintenance revenue on the fleet that remains in service. Airports that spent hundreds of millions rebuilding for the aircraft will keep collecting landing fees on it for another decade at least. Every one of them made a bet on the A380 that paid off within their specific piece of the puzzle. Airbus made the biggest bet of all, and it was the only one that never paid off. The company survived in the end not because of the A380, but because the A350, the aircraft airlines forced Airbus to build almost as an afterthought, turned into one of the most successful wide-body programs in aviation history. The A380 remains flying, admired, and profitable for nearly everyone connected to it. Just not for the company whose name is written on the tail,